The silver and gold bottom signal. Wall Street isn't talking about somewhere in the bond market. A single number is quietly moving, and almost no one is watching it. But history says when this number turns, gold and silver don't just recover, they explode. The last time this exact signal appeared, it came right before the two most explosive precious metals rallies in the last 50 years. And right now, it's happening again. But there's a catch, because before the breakout comes, there may be one final trap, one last move designed to shake out everyone who isn't paying attention. Stay until the end, because the difference between watching this moment and missing it completely could define your financial decade. Welcome back to Precious Metals Intelligence, the channel built for investors who prefer evidence over emotion and strategy over speculation. If this is your first time here, this channel exists for one purpose: to help serious, thoughtful investors read the signals that institutions read before the broader public catches on. Before this begins, a respectful request. If you found value in analysis like this before, consider joining the small but growing community here by subscribing. This isn't about vanity numbers. It's about building something worth returning to week after week for the kind of steady, long-term thinking that tends to matter more after 50 than it did at 25. And one more thing. It always helps to know who's watching. So in the comments, let us know. What city, region, or country are you tuning in from today? Most investors watch the wrong chart. They watch the price of gold, they watch the price of silver, they wait for the candles to move, and they react only after the move has already happened. But the analysts who consistently catch the big turns in precious metals are not watching gold at all. They're watching something far less exciting on the surface, the bond market. And inside the bond market, one relationship matters more than almost anything else. It is called the yield curve. In simple terms, the yield curve compares two interest rates. One is the rate on a 2-year U.S. government bond. The other is the rate on a 10-year U.S. government bond. Normally, longer-term bonds pay a higher rate than short-term bonds because lenders want to be rewarded for locking up their money for a longer period. But the gap between these two rates changes constantly. Sometimes it narrows, sometimes it widens. And that change, subtle as it seems, tells a much bigger story about where the economy and gold are headed next. For years, most analysts believed that gold was driven primarily by something called the real yield. This is the return an investor earns on a 10-year bond after subtracting inflation. When real yields rise, gold usually struggles because investors can earn a safer, more attractive return elsewhere. When real yields fall, gold tends to shine. This relationship has been studied extensively, including by major financial institutions, and for a long time it held up well. But something has shifted. In recent years, a different signal has proven even more reliable than the real yield. That signal is the steepening of the yield curve itself, the widening gap between the 10-year and 2-year rates. When this gap begins to widen, it tends to align closely with major turning points in gold. Not small pullbacks, not minor dips. Major, multi-year bottoms. And right now, that gap is widening. For much of this year, the yield curve had been flattening, moving in a direction that offered little support for gold. But over the past several weeks, that trend has reversed. The spread has been climbing steadily, reaching levels not seen in nearly 2 months. On the surface, this may sound like a minor technical detail, buried deep inside financial data that only bond traders care about. But for those who understand what it represents, it tells a very different story. It tells a story about the relationship between short-term and long-term borrowing costs, and why that relationship, more than almost anything else right now, may determine where gold and silver go next. Here is the deeper mechanism at work. When long-term interest rates rise faster than short-term interest rates, it becomes harder for the Federal Reserve and the broader financial system to justify keeping monetary policy tight. Long-term borrowing costs affect everything: mortgages, corporate debt, critically, the cost of financing the U.S. government's own debt. When that pressure builds on history does not repeat itself in exact detail, but in financial markets, it often rhymes in ways that are too consistent to ignore. And when it comes to gold, one rhyme stands out above the rest: the moment when the 2-year Treasury yield reaches its peak. This single data point, often overlooked by casual investors, has appeared again and again at the exact turning points that mattered most for precious metals. Consider what happened in 2018. At that time, the Federal Reserve was raising interest rates aggressively. Short-term yields climbed higher and higher, pulling money away from gold and into interest-bearing assets. Investors saw little reason to hold a metal that pays no yield when they could earn a growing return elsewhere. But then, quietly, the 2-year yield reached its highest point and began to roll over. Almost immediately, gold found its footing. What followed was not a minor bounce. It was the beginning of a major, multi-year upward move. The pattern repeated at the end of 2023. Once again, short-term yields had been climbing. Once again, gold had been under pressure. And once again, when the 2-year yield finally peaked and started declining, gold responded almost in lockstep. This particular bottom turned out to be one of the most significant in recent memory, setting the stage for a powerful rally that eventually pushed gold to new heights. There was one earlier case in 2022 that tells an equally important story, but with a twist. Gold actually bottomed a full year before the 2-year yield made its major move. At the time, an unusual and unexpected event was unfolding. The Russian invasion of Ukraine. That single geopolitical shock pushed gold sharply higher, ahead of schedule, disconnected briefly from the usual bond market rhythm. But once that shock faded and interest rates continued climbing, gold gave back much of that early gain, only stabilizing again once the broader yield pattern caught up. This is an important lesson for anyone trying to time markets using a single indicator. No signal is perfect. Geopolitical shocks, unexpected policy decisions, and sudden shifts in sentiment can all interrupt the usual pattern temporarily. But over a longer horizon, the relationship between a peaking 2-year yield and a major gold bottom has proven remarkably consistent. Why does this happen? The logic is straightforward once explained simply. The 2-year yield reflects what investors expect the Federal Reserve to do with interest rates in the near future. When that yield is rising, it usually means the market expects more rate hikes ahead. Higher rates make gold less attractive compared to safer, yield-paying alternatives. But once the 2-year yield peaks, it signals that the market believes the hiking cycle is ending. That shift in expectation removes one of the biggest headwinds gold has been facing. And once that headwind fades, buyers often return quickly. This is why so many experienced analysts watch this single number closely, even though it rarely makes headlines. It does not carry the emotional weight of a Federal Reserve announcement. It does not trend on social media. But time and again, it has marked the precise moment when fear turned into opportunity for those paying attention. Right now, the market finds itself in a similar position. Short-term yields have been elevated, gold has been under pressure, and the key question on the minds of serious investors is simple. Has the 2-year yield already peaked, or is one final move higher still ahead? If history is any guide, the answer to that question may determine whether the current period marks the final low of this cycle, or merely a pause before one more test of investor patience. Behind every chart, every yield curve, and every interest rate decision, there sits a much bigger and far less comfortable story. It is a story about debt. Specifically, it is a story about how much debt the United States government now carries and how expensive that debt is becoming to maintain. Most people rarely think about government debt in personal terms. It feels abstract, distant, something that exists only in news headlines and political debates. But the mechanics behind it are surprisingly simple, and they matter enormously for anyone trying to understand where gold and silver may be headed next. Here is the basic picture. The average interest rate the government currently pays across all of its outstanding debt sits at a level that, for decades, would have seemed unusually high. This year alone, a staggering amount of that debt must be refinanced, meaning old, lower-rate debt is replaced with new debt issued at today's higher rates. When that happens on a large enough scale, even a small increase in interest rates translates into a massive increase in total interest costs. Consider the math. A rise of just 1 percentage point in the average interest rate on government debt does not sound dramatic on the surface. But when applied across many trillions of dollars in outstanding obligations, that single percentage point translates into hundreds of billions of additional dollars owed in interest every single year. When compared against total federal revenue, that additional burden represents a meaningful and growing share of everything the government collects in taxes. This is not a hypothetical scenario. It is already unfolding. Net interest payments on the national debt have climbed to levels not seen in nearly a century since the earliest years of the Great Depression. That comparison alone should give any serious observer pause. It suggests the country is entering financial territory that modern generations of investors, business leaders, and policymakers have never personally experienced. To understand where this may lead, it helps to look backward, to a period that shares striking similarities with today. In the mid to late 1960s, the United States experienced a long, powerful bull market in stocks. That bull market eventually reached its peak. Around the same period, long-term interest rates crossed critical thresholds, first near 5%, then climbing towards 6%. Once those thresholds were breached, the long secular bull market in equities came to an end, giving way to a much more difficult and volatile period for investors. Today, long-term Treasury yields are once again approaching similar territory. The 30-year yield has already pushed to levels not seen in years, moving firmly into what history suggests is dangerous ground. The 10-year yield remains slightly below that same historical warning line, but it is closing the gap. There is, however, one critical difference between now and the 1960s. The overall level of debt across the economy today, government debt, corporate debt, household debt, is far greater than it was 60 years ago. The entire financial system is more leveraged. more interconnected, and more sensitive to rising borrowing costs than it was during that earlier era. This difference matters enormously. In a truly free market, rising yields would likely continue unchecked until they forced a painful economic correction, much like the one that followed the late 1960s peak. But with debt levels this high, that kind of free market outcome becomes increasingly difficult for policymakers to tolerate. The consequences of allowing yields to rise unchecked today would be far more severe than they were 2 generations ago. This sets the stage for a critical question that every serious investor should be asking right now. If the free market cannot be allowed to run its natural course, what happens next? Who steps in? And more importantly, what does that intervention mean for the value of paper currency and for the assets that have historically served as protection against it? That question leads directly into the next part of this story. Every financial era eventually reaches a point where the old rules stop working. The debt burden described in the previous section is not a temporary inconvenience. It is a structural problem, and structural problems tend to force structural responses. This is where the story moves from historical pattern recognition into something more forward-looking and more consequential for anyone holding real assets today. When a government carries this much debt, and when refinancing that debt at higher rates threatens to consume an ever larger share of national revenue, policymakers face a narrow set of choices. They can allow interest rates to rise freely, accepting the economic pain that follows, or they can intervene directly in the bond market to prevent yields from climbing further. Historically, when debt levels reach the scale seen today, the second path tends to win. This kind of intervention has a name. It is often referred to as yield curve control. In simple terms, it means a central bank or government body actively works to cap long-term interest rates, buying enough bonds to keep yields from rising above a chosen threshold. It is not a new idea. It has been used before in other countries and in earlier periods of U.S. history, particularly during times of heavy government borrowing. Alongside yield curve control, there is another likely tool: interest rate cuts. Even if the broader economy does not appear to require lower rates based on traditional measures like employment or inflation, the sheer cost of servicing government debt may eventually force the central bank's hand. Lower rates reduce the interest burden on new debt issuance, offering some relief to a system under mounting pressure. For everyday business owners and professionals, this may sound like a distant policy debate with little personal relevance. But the implications reach directly into personal wealth and financial security. When a government manages its debt burden by suppressing interest rates or expanding the money supply, it does not eliminate the underlying problem. It shifts the cost elsewhere, typically onto the value of the currency itself. Historically, this kind of environment has been extremely favorable for hard assets, gold and silver among them. This is precisely why so many experienced investors are less concerned with the exact price at which gold or silver bottoms in the short term. Whether the low occurs at one specific price level or another becomes almost meaningless when viewed against the larger picture. What matters far more is the direction of policy over the coming months and years, and what that direction historically means for assets that cannot be printed, diluted, or defaulted upon in the same way currency and bonds can be. There's also a longer historical thread worth understanding here. Major secular peaks in the stock market have, throughout modern history, been followed years later by major secular peaks in precious metals. This pattern held true after the market peak of 1929, after the peak in the late 1960s, and after the peak in 2000. In each case, gold and gold-related investments reached their own major highs roughly 8 to 11 years after the broader stock market's secular peak. If the stock market is now approaching a similar long-term turning point, the implications for the multi-year path of gold and silver become significant. None of this suggests an immediate, dramatic event. Structural shifts in monetary policy tend to unfold gradually, often disguised within routine-sounding announcements about interest rates or bond purchases. But for those who understand the underlying mechanics, the direction becomes difficult to ignore. The bond market is signaling one thing, the debt mathematics is signaling another, and history, when read carefully, tends to align both of these signals in the same direction. The final part of this story brings these threads together and addresses the question every serious investor ultimately needs answered. What does this mean, practically, for those trying to position themselves before the next major move begins?